Okay, hello. Great, let's start. You have a roll call?
So, committee member Moore.
Present.
And member Wu are absent. Vice Chair Mohan.
Yeah.
Chair Schmidt.
Here. Great, we've got a quorum. And welcome everybody to the new year and the audit committee of 2025, I guess, we'll call it that. Lots of good stuff. Orders of the day, I always wonder what those are, but I don't think we have any, so it's on our agenda. But the approval of the minutes, let me ask if everybody's read those, or Sheila
I have.
and Mark, have you had a chance to read the minutes?
I'll be abstaining this vote, but you'll still be able to pass it with a 2.
Yeah, okay, I see, okay, so, and committee member Mohan.
To approve the minutes.
Okay, and one adjustment that I wanted to make.
I saw that.
Got it, so, okay, so your motion is to approve the minutes as adjusted by city staff.
More second?
Okay, great, we've got, let's take a vote. All in favor? Aye.
I abstain.
Perfect. Thanks, everybody. Oral communications. We may have some. I don't know if we have any on YouTube either. I guess we don't have them because somehow it's a hybrid and they don't participate, but we do have, I don't know if you have.
Staff.
I'll just take the time to introduce.
Yeah.
All right, this is Richard. He is our new senior accountant.
Oh, fantastic.
He's
Welcome.
been quite some time, 18 years.
Yes.
18 years as an accountant, so he's stepped up as Beth has separated from the city, so he'll whenever I'm not around, he'll be he's my right-hand person, so stepping into my shoes when needed.
Fantastic. Welcome. Congratulations and welcome. And sorry I didn't recognize you, a long-standing member of the team. Okay, that's very good. Which brings us to, just to confirm, we're going to follow our agenda because everybody's timing is consistent with that. Great. So first item is item number 2, receiving the OPEB and pension section 115 trust performance report for quarter ending December 31st, 2024. And usually what we do is hand this over to FARS or US Bank, where I think I saw Jennifer on the screen there. So you want to kick it off, Jennifer or Jonathan?
And Jonathan, I apologize. Do you see Keith Stribling in the waiting room?
Now let's take a quick peek. I don't.
Oh,
Let me see.
I'm connecting with video.
For your patience, just typically don't have this. I also need to do the.
Yeah, I'm connect.
Live streaming, but not doing the recording. So I'm sure video can take the live stream and port this over as the recording. Now I can like do panels. Not that.
Oh, there's one now. Here's Angela.
Keith, can you hear us?
Sounds like we can't hear Keith either.
Looks like he did unmute.
Can you unmute him?
Sorry?
Did you see one?
Keith is on. Keith and Angela did join us. Keith, it looks like we may have some audio issues.
Are you guys able to hear me okay?
Yes, you can hear Angela. Thank you.
Okay.
Different answer. That's not.
Difference. Facebook posts.
You just can't hear Keith.
No. It's having some audio issues. He just logged off, so he's probably gonna try the wrong or.
Hi, can you hear me?
Oh, yes.
Awesome. And there's my
Yes,
video. It was funny. I was trying to figure out where my video was too. There we go.
Well, welcome, Keith. You've heard over the technical problems. And Happy New Year to everybody.
Great.
Angela, we've got all three of you on the screen in the room.
Okay, perfect. Well, thank you all so much for having us today. Dennis Mullins was unable to be here for today's meeting, but in his place, Keith Stribling from PFM is going to be presenting today's report.
Great.
Okay, Keith, you can go ahead.
Great. So I'm not seeing anything right now. Weirdly.
Okay, I
Can
have
you
the
guys see me?
presentation up to slide 8.
Okay, I can't see the presentation for some reason. So I'm not sure what slide 8 is. Can everybody see the presentation except me?
Here, so Keith, we have page 8 of the PARS US Bank statement.
Okay, so I'm hang on a second. Let me just see if I can. I'm gonna pause for a second here and try and find the presentation in my email and open up my own copy so that I can see what page we're on. I'm sorry. For some reason, I'm not seeing the presentation. All right. All right, I've got it. I'm not going to have my video on so I can toggle in between, so I can look at this presentation. I hope you don't mind.
Sure, Keith.
Yeah, sorry about that. I don't know what's going on. But so we don't waste a lot of time, let's start on page 13, lucky 13. That would be the performance page for the OPEB plan. All right, so things to highlight in here. First thing I would mention is we recognize that we have the S&P 500 as the benchmark. And if we're looking at the previous slide, the MSCI AC World Free Index is the actual benchmark. So I will make sure that my colleagues add that as a line item at the top in future presentations, and also make sure they have that under the equity comparison. Just looking at it, you can see last quarter was basically a change of administration that caused a lot of changes in the financial markets, including higher interest rates. And so Things like bonds down 2.5%, which outperformed the benchmark, down 3%, but still negative. And interest rate sensitive REITs and were negative as well. So that kind of dragged down the portfolio returns. Also, the only thing that was really, and also foreign equities were negative, but that was probably mostly just dollar appreciation. So dollar can have a big impact on the value of currencies and returns for foreign equities. And in this case, higher interest rates, higher growth rate equaled a stronger dollar, which hit international returns. Generally speaking, you can see over the inception to date time period, portfolio compounding at almost 7%. So it's doing quite well. Looks to be under the benchmark. I'm assuming that's the benchmark, 7.5%. Of course, don't have the history on the portfolio, so I can't really speak to that too much. But regardless, whether it's in line or not, 7% is a pretty good return. This one is a balanced strategy, so it's a 60-40 mix of stocks and bonds. I'm just going to talk briefly about, I apologize for my voice. I have a bit of a cold today. So I'm just going to talk briefly about the economy, the change in the economy, and how that might impact holdings. So we got a change of administration in November, and it is a more the Trump policy direction will be more pro-growth agenda. Things like tax cuts and government regulations are stimulative to the economy. Immigration and tariffs are potentially inflationary to the economy. He's also called for lower interest rates, so that would be stimulative to the economy as well. So his policies are generally potentially inflationary and pro-growth. This could force the Fed to pause its foreseeable interest rate cuts as the yield curve, has steepened a bit and is no longer inverted. We are basically positioned neutral to the strategic asset allocation, looking at the risks of the Fed having to stop lowering rates, inflation picking up, global unrest, balancing that with fundamentals that still favor a soft landing, no recession, and accelerating growth. So between those two, we kind of come right down the middle. Any questions before I leave this area?
Yeah, Keith, I think this is usually a great slide to ponder a bit. So putting it up to if other committee members have anything, I'll jump in. But I do have some questions. I'm glad you prefaced by saying we've got the S&P index on this particular slide, and you're going to look in, or the team will, into having it match the benchmark, which is on other slides that we've had for years. But I got a couple questions on looks like if you just look at the year column, which sort of filters out maybe last election type of results that you're alluding to, which are pretty volatile. But for the whole year, it's pretty amazing to me. The total fixed income seems to have been 2.53% that the city achieved. Whereas the index was, if I'm reading that correctly, the BBARC, I think, or however you pronounce that, BBARC Global Ag was a minus 1.69 for the entire year. So I'm kind of curious what, first of all, comprised that difference. Why did the city do so much better than the index?
Yeah, so that's a good question. And what I would say is the Barclays Global Aggregate Index includes foreign bonds. So U.S., that's going to have an impact from the dollar strengthening. Whereas if you look at the Barclays Ag, it's just U.S. and it's a little bit more, at least it's directionally the same. It's still below the portfolio still outperformed it, but it's a little bit more correlated.
So the city, just so sorry, I'm going slow. I got to sip some more coffee. So I guess the index, the BBARC, has foreign bonds in it, and
The global one, yes, because they're both Barclays Bloomberg Aggregate Bond Index.
yeah, which is a good question. While we're on that, I'm not sure why you're including the BBARC U.S. aggregate then, since God on.
So what I would say there's no downside. And like, if I were doing this, I would add your appropriate benchmark to the equities. I might keep these other benchmarks also so that we could talk about what worked and what didn't. So you can see, for example, for the year, S&P 500 up 25%, small cap stocks up 8.7%. So to the extent you had anything other than the S&P, which is overweight in the Magnificent Seven, you're going to underperform that benchmark. And I don't actually know what your index return was, but it would be a way just to see like internals of the market and how they performed. So,
Okay, so
you definitely want to have the benchmark in there. I'm not suggesting don't have that. I'm just saying it's nothing wrong with having some extra benchmarks in there too.
okay, that's fair. I think I understand what you were saying, but I agree also, it's useful to have extra information at other indices and compare and see. That's all good. So, but I guess maybe we can come back to it next quarter if it's not obvious right now. But my question is, I guess, why the city did so much better over the year in the fixed income category as opposed to the index. And I guess if it's because we're not matching the index because we're, for example, not investing in foreign bonds, which the index does invest in, then maybe we should be using as our primary comparison the domestic bond index. And that's why I was, trying to puzzle over why we're 4%, almost more than 4% for the year 2024 over what appears to be our index, which is the BBARC one that we've had for years in there. So I'm just this is the year for always looking at new things. So apologize to put you on the spot. You don't necessarily.
That's okay.
I guess I can register as a question.
If you go to page 23,
Excuse me?
if we go to page 23 real quick,
Okay.
Where
this
there-
has the holdings in it. So not being familiar with the Fidelity US Bond Index Fund, but I'm guessing that by the fact that it says US Bond Index Fund, it doesn't have foreign bonds in it, and the high yield fund doesn't. So just if you want, the benchmark is sort of an organizational decision. Is if you want the global benchmark in there, then it just means the portfolio manager is either taking a bet against foreign bond. If they have this position versus that benchmark, they're taking a position of betting against foreign bonds, basically. That doesn't necessarily mean is a bad thing. It's just a portfolio management decision. But if that's not really what you want, then there's no harm in changing that benchmark.
Okay, Keith, we're on the same wavelength. This is the music to my personal ears. So I think we're not talking right now, at least I'm not talking about changing the index. Okay, we put the index into the investment plan that gets approved annually. So right now we're looking at really the performance of the investments that PFM has made in order to meet that investment policy document that City Council and Audit Committee previously agreed to. So all that is great. So let's not talk about changing the index. Let's keep the index just the way it was. And is the fixed income. If you go to slide 12, Keith, maybe we should go there just for a moment.
Sure.
In the fixed income category, we've got the BBARC Global Aggregate Index. So I'm very happy to have a discussion when we get around to looking at the investment policy whenever we do that later in the year to sort of see, is the BBARC the right index? But that's not really the task right now for this particular meeting that we have. Every quarter.
I will let Dennis know that issue came up. And I would just also say, I don't believe I have many, if any, clients with the global bond index. They almost all have the US ag.
Okay. Well,
if that's any help.
Yep. Yeah. I'm somewhat embarrassed that we as a committee haven't surfaced this over the past, many years, but why don't we sync up what you guys think is a decent index for the city? And in the meantime, we will, ask you why we're varying from the current index that's in the policy. And right now, it sounds like we might have come across a couple of examples. One is maybe there's some high yield that's, in our portfolio, in the city's portfolio, that's not in the BBARC Global Aggregate Index. There's also some
Right. There's
foreign
also a
bonds,
deviation here.
that may have been in there. So it's interesting that foreign bonds did maybe better than US bonds last year, but I'll take your word for it. That's good. So so I'd like to do the same thing that you jumped to, which was the equity side of the house. The MSCI AC free index, as you can see, is our long established benchmark. So going back to your page 8 that you were pointing out to us, that there's or whatever page you were on, that page. It'd be nice to sync that one up too. And I know you were saying the same thing, and I don't mean to rehash it so much, but what I do is go down this chart because it's the key summary. And if I look at the fixed income, there's a big difference between the index, which we just addressed. But if you go back up to the equity side, not that big a difference on the year for the equity index, assuming that again, this has been constructed so that you're using the index. So that might be something your team wants to go back and confirm for our next meeting, that the third row there where it says City of Cupertino, that you're actually using the index that's on the other page, MSCI AC World Free Index. But I assume you are, right?
Yes, so this is my introduction to you guys, so I don't know all the answers, but I'm taking notes to make sure I do want to be careful not to just say things that end up not being true.
Okay, no, yeah, that's
I
great.
was saying the same thing. Let's just say no.
Yeah. So I think Jonathan is well attuned. We had some talks about this, I think, just last week. So that he can answer any detailed questions. Some of us are happy to hop on a phone call. But Sheila, you had a question.
I did have a question. I think maybe at the October meeting, we had talked about these benchmark indexes and when was the last time it had been refined? And any changes since October?
We have not made any of these changes since October. These have been, the actuals may have changed, and that's going to change depending on what portfolio manager chooses, right? But as far as the benchmark or the targets, those have remained the same. They haven't changed since I've been here. They've been pretty constant whenever we provide that to the audit committee as part of the investment policy, both for OPEC and the pension.
Okay, and I think
I was just gonna say, I might add one thing. Usually if there's a benchmark change, they show another page with it'll say the 2020 benchmark, and then it'll say the 2024 benchmark.
Right.
So usually, so that leads me to believe this has been what it has been since the beginning.
Okay, if I remember right, part of the discussion we had was about how relevant are these benchmarks and the need for the benchmarks to be relevant to our particular city.
Yeah.
I'm not sure what action was taken.
We've started this conversations, and in 2025, we'll start to see some adjustments being made. So we'll be working closely with Dennis to make sure that the benchmarks that we set or make those comparisons are relevant. So in that previous page, I believe 13, what we're setting as an example here of the MSCI rather than S&P 500. Another that Chair Schmidt had made in the October is if you go to page 11, you'll see the comparison here is to the S&P 500 rather than the MSCI. So making those adjustments to the report would be more user friendly. So you can compare our performance is and what that is to the benchmark, right? And so we have that.
And I'd just add, You can see here a massive underweight in technology, but that other index is more broad and it includes mid and small cap stocks. So that would dilute this because, of course, technology is heavily weighted by the largest companies, and S&P is a large cap or is a cap weighted index. So it probably isn't as overweight or underweight as it appears.
Sheila, you wanted to
The-
remark there, yeah.
No, the SP 100, that made sense, and I'm glad we start. But Jonathan, you said something about user friendly. I think the issue is not so much being user friendly as relevant.
And then if in case benchmarks do need to be adjusted, we would have to update the policy. So should we decide to change the marks between here and next October, we would have to bring that policy back to the audit committee and then city council. And then we can open up that discussion, maybe at the next audit committee, we'll have discussions with the chair and see what's the most appropriate time to do that, or just to wait till then to see if that's just continue the cycle.
So I think to recap that great little interaction there, Keith, I think the understanding that I'm getting is you're going to go back and see whether you can redo the performance, the indicators that are benchmark indicators on the performance part. We're not changing that, our index whatsoever. We're keeping that. Page 12 is not being discussed next meeting any more than it is this meeting. This is in the policy document. But what we are talking about is changing the other indicators that you show on that page 13 or any. There's a few other pages that we've already alluded to. So I think the main goal, Keith, is to be able to understand, well, what kind of PFM decisions were made that caused the fixed income portfolio that the Cupertino city has to exceed the index by 4%. That's usually going to indicate, either a higher risk or, like we've surfaced here, there's maybe foreign bonds that are causing us to look in. So that kind of decision, we're not just doing this to give your life more difficulty. And I think I did hear one of your teams say last time that you may not have these indexes in your database, which would be astonishing to me, but let's hope that's not the problem.
I don't know. I don't, because I don't think I have, like I said, the Barclays Global Bond Index, I'm sure I don't have that as a benchmark in any of my client accounts.
Okay, so when you say that, I guess maybe it makes me a little nervous that you can't really choose the index, but we'll address it next quarter when you come and maybe between now and next quarter, you can alert Jonathan as to what's going on and we can adapt accordingly.
Yeah.
Much appreciate your patience with us as we face the new year and we're trying to make things more relevant.
Yeah, totally understand it.
Okay, so I think the 115 pension is very similar to what you showed us for OPEB.
Yes.
I don't go to that in any more detail unless committee members have an appetite. I see no. So anything else that we should cover? And Sheila.
I think about months ago when at the city council meeting, we had what to do with the discretion, the reserve. And the decision was made that we would take 10 million and pre-fund
CalPERS. CalPERS. But yeah,
So does that show
that
up?
wouldn't be
here?
reflected here. That was directly out of our discretion or well, it was unassigned
technically-
fund balance, but this couldn't technically be, this is separate. So this is not included in that. It was in a sense pulled from our cash.
Didn't it have something to do with the pre-funding?
So pension, the section 115 trust,
Right.
we could have used, which is that second account. If we go down to page.
The performance page is 19, I believe.
Yeah, we could have pulled it from here to pay that down.
Yeah,
But
you
we
have 20 million in
The
there.
city decided to use the funds that were relieved from the due to the settlement from the CDTFA to use part of that 74.5 to 10 million to pay directly towards helpers as an additional discretionary payment.
Okay.
So that's how it was paid. And so directly came out of the city's checking account. We did not need to move funds around from the Chandler portfolio or Lane. It came directly out of the check.
But it
Correct.
direct.
Directly from the change.
Marvelous. That was a great clarifying question. I was thinking too that it was going to get added maybe in 2025 to this fund, but now we don't have to worry about that.
I mean, the city does have discretion to pull these funds to pay that UA out direct, should they choose.
Which is the purpose of this.
Yeah, maybe I'll just add a comment to that.
Sure.
One of the things I think is really nice about the 115 trust is you're allowed to invest it in a way that is, similar risk profile to CalPERS pension. But by having money here in the 115 trust, it gives you the financial flexibility should anything go wrong, where you have, some reason you need to pay your CalPERS liability, but you have other obligations. So, it's still growing in a similar way to CalPERS, but gives you as a city financial flexibility to manage your obligations. And so just pulling it just because it's there is not usually my recommendation. It's usually like in a moment when you really need it.
Okay, thanks, Keith. I think we have deliberated. Appreciate your stepping in and answering our questions, and look forward to talking with you more in future meetings.
Great.
I think the action for us is to accept this report, which I sometimes we do motions, and I think the more efficient way is we have a consensus here. We've now accepted, I think. All of us are nodding our heads. So thank you, PARS and US Bank, and we'll see you probably next time. Bye.
Bye-bye.
So our next agenda item is, and again, I offer up any help that I can separately if city staff wishes to have me, what screwball questions I might have been talking about. I think we're on the same wavelength, obviously. For some reason, we just have not paid attention to those indexes, and I don't know how that slipped past us. So my apologies as a longtime committee member.
So we passed them. We just didn't act on it.
Oh, yeah.
It did come to our notice though.
Yes, you're right. We started last year, but now I'm getting a little more impatient because, to be honest, it's been at least this is probably the third meeting that I can recall. So I do look forward to their responsiveness. So next agenda item then is the informational item, receive the internal audit, fraud, waste, and abuse programs update. Chelsea, it's probably over to you or Jonathan, but I'm guessing it's you, Chelsea.
Hi, everybody. Good evening. I will share my screen here and walk you through the internal audit status update. So this is from October 21st all the way through January 22nd of this year. There's 4 programs that were in this fiscal year. And so just kind of want to walk you through those 4 programs that belong to the internal audit program. So the first one is the grant management internal control review. We are going to kick that one off in February. We plan to finish that in May. So nothing for this period, but next period we'll be initiating that field work and conducting our analysis. We also have the special revenue fund process review. We started this in August and we're going to go hopefully through July of 2025. There's been some delays with scheduling. So we have this period, we were able to confirm the interview list for 1 department, but we're still awaiting confirmation from 2 other departments to really kick this off and get it going. So for next period, we're going to be scheduling those interviews with individuals on the lists and hopefully getting some fruitful information on that one.
Hey, Chuck,
Go ahead.
that column, could you help me with the acronyms? It's CDD, PW, and PNR? Just wondering who those, Jonathan's gonna help, I guess.
That's what, so CDD is Community Development
Ah,
Department.
of course.
W Public Works.
Okay.
Parks and Rec is PNR, but to be honest, I think that was a typo on our end. I think when we submitted it, it wasn't supposed to be Parks and Rec, it was just supposed to be Public Works.
Yeah. Well, I should have guessed those, but thank you. Sorry to interrupt your flow.
No, absolutely. Please ask questions when they come up. Going on though, recommendation validation process establishment. This is an ongoing project throughout the entire year. So that started in July and we're going to go all the way up until June. And so this past period, we received documentation and we're beginning to validate recommendations on city staff reports, making sure that those past findings have been implemented and corrected. We're going to continue to work with the city to validate those recommendations and make sure that city staff reports are implemented. So that will keep on going and we are making progress. So great news. And then lastly, there is the ongoing internal audit services. That's what I'm doing today. So that's when we attend those audit committees and council meetings. We prepare the status reports that you're seeing today. We also monitor the fraud, waste, and abuse. No problems. That is running smoothly. Any questions on those 4 items?
The third column with the gap. My question is, I guess you have quick access to all the internal audit recommendations, so I can guess how you got those. Can you maybe talk a little more about the external audit and what periods? I think the audit, because there was a new auditor, they came on, they went a little bit, the timing is a little different. I'm wondering if maybe you've got comments from a couple of years, whereas, so my general question is, how many, if any, external auditor recommendations do you have in your inventory that you're checking the gaps on?
That's a great question. You know, I am not the project manager on this, but I do believe, and I can definitely have the project manager reach out to you. I believe it's all external audit findings. So it would have gone back, you know, and Jonathan, please let me know if I'm misstepping here, but I believe it is all audit findings. Is that correct?
To be frank, I'm not sure how far back we were going back. I think as far as I know, as far back as when Moss Adams started as an internal auditors. In maybe going too far back, I understand that in certain situations from year over year, if there's a deficiency that is highlighted or an internal process, it will stay as a deficiency. And so if it's an ongoing issue, you would see it year over year. And so with the latest audit, if there was the idea is with the latest one would actually kind of call out, has there been any findings? If there's been a correction on the city's part as far as its process, it would actually no longer include that as a finding. So by omission, it's essentially saying that there's been a correction. Sometimes you have from one auditor to the next, there might be a difference of opinions, and that could also change things. So some auditors are more sticklers on certain processes than others.
Fantastic. Yeah, that makes a lot of sense. I wasn't even thinking of that. That makes perfect sense. The external auditors, you would think, would have been looking at what happened in the previous year. But to be honest, I don't remember any comments. These things used to be called internal control efficiencies, or was there a report like that separate that was calling those out that we looked at last year? And I'm just not recalling it right now.
Yes, and the biggest one that calls to mind was the prior period adjustment that was having to deal with reclassing certain revenues to
unidentified liability.
Yeah.
Asset, unidentified asset.
Correct. So yeah, so those are the type of things that they'll call out, and that wasn't an issue in the 23-20. Sorry. 23-24 audit.
Yeah.
So that was corrected then. So the first year, they had that finding, the 23-24 was a much more cleaner year. It was the second year, so we've cleaned up a lot of those issues. And as you know, we were able to bring that audit to council much sooner. So as we're kind of moving along, we're making those refinements and adjusting. So every year, things will, they'll find new things to that go digging into. So as of now, from my perspective, I don't think we have.
Found the list. It says for 2022 single audit. A single audit, I guess, SA-22. So I'm not sure what that means, but it looks like the only one that's under review that I can tell would be the 2022 single audit for our external.
Which is that's federal, so whenever you expense over 700,000 in federal funds, it triggers the city to have a single audit. So this will actually be the next year, we're undergoing that second single audit. And this was due to capital improvement for a street project. And so 2 years ago, there was also a finding relating reporting. So the city missed a reporting deadline, or
Right.
it was not so much of a reporting deadline, but partly misreporting. There was some confusion between auditors and how they interpret what's considered a revenue recognition or loss versus attributing to an expense. So there was
Moss Adams will go into that detail, but to
sorry.
answer
Thank
your question, that's the only one that's on it, the single
Great. Okay,
recommendation from 2022.
appreciate it. And my last question, anybody else chime in, but this is like a point in time type of gap where you're helping establish a process that the city will then take and be able to update over time. And either way, it'd be interesting for us as an audit committee to be, and if it is an ongoing thing that you guys are supervising, then you'll be bringing it to us without any problem. Otherwise, maybe we have more discussion or whatever.
Absolutely, yes. So this would be something that we would be going forward with, and validating that recommendation process throughout the audit years.
Great. Seems like a great project for me. I always liked it. Any other questions for Chelsea?
Moss Adams also did that, the policy inventory and gap analysis. Right? So that's not here?
That's
Well-
correct. That was from the last fiscal year. So we were catching up. So last time I talked with you all, that was still on the status update, but that has since been finalized.
Oh, okay, because there were maybe one, I remember the sort of red line item.
CIP.
One particular one. What is it?
CIP
CIP.
policy.
So are you saying that's been
So
resolved?
it came to audit committee twice,
Uh-huh.
because we made a slight change, because it had the council on the administrative policies. So now Moss Adams handled all of the administrative policies. Staff is doing a deep dive into council policies. So we're trying to get that, once that component is done that is on staff, we'll finish that and bring that to council. Right now, we're anticipating March.
Okay,
To
so
be able to bring,
it doesn't go back to Moss Adams?
so Moss Adams will present it at city council,
Check it.
but the council policies, because all the council asked for was an inventory, we're gonna bring that inventory to council to say, based on our search, here are all the council policies we were able to find, for council to do whatever direction you want to give us to do with those policies. And then for the administrative ones, Moss Adams has looked at them and has recommended kind of an implementation schedule to either put policies together and or update policies. So both of those will come to council, likely the second meeting in March.
So their responsibility is over?
For the policy, for the administrative policy, yes and no, like for the policy audit, yes, but then this will roll into the validation process. So based on what staff agrees to get stuff done, Moss Adams will be checking in with us and saying, hey, you were gonna update this policy.
Yeah.
Where's the updated policy to validate that we're doing what we said we would do?
So with regards to the hotline statistics, are we going to be hearing more about those reports that are open? And could we when a case was opened, how long they've been open. So we have some sense of how long these take.
Yeah, that's, very fair. And I was gonna go into that. So let's first look at what happened this past quarter. There was one complaint that came into the fraud, waste, and abuse hotline. We referred that to appropriate city officials, and it has subsequently been closed. As you can see, we also give you the hotline statistics. So from when we started the fraud, waste, and abuse hotline, that was back in October of 2022 through now. There's been a total of 29 reports, and there's 5 that are still open. So we do check in. So those have been all obviously been referred to city, the appropriate city officials. We do check in with those city officials. There's, if they're under investigation or whatnot, from time to time to make sure that there's still progress and movement and that they have not been closed. We typically would not give the committee unless, it is warranted that the committee needs to know. We would not give those details of the extent of what they are and how long they've been open. Going strictly from what your policy, your fraud, waste, and abuse policy is.
If I'm thinking through the chair, we can make some deductions about how long they've been open, given we get this, the audit committee gets this report. And for instance, the last time I recall checking in, there were 3 open reports and now I see 5. So somewhere between the last time I checked in and now, then something else started and then I can infer that the cases have been open for some time. Okay, all right, thank you.
Chelsea, would it be too much to ask if there's cases open that pertain to a previous quarter? Can we have some sort of statistic showing the length they've been open to?
We can definitely do that. If the committee wants the length of how long the reports have been open, I can definitely make note that next time I present this, there would be a length time. Is that something the committee is interested in?
I think that would be helpful. I think we've also asked in the past about the fraud element, and of course, there's legal confidential elements. We're not necessarily trying to drive into those, and there's categorization over the telephone that may not be accurate. It may not be an employment issue or whatever. I think anything that makes this more informative. I mean, it's informative as it is, but sometimes it raises more questions. What are those 5? And I know we can't go into a lot of detail, but certainly if one of those 5 relates to October of 2022, that would be something that we would inevitably want to ask city staff more about, I would think, for example.
Absolutely, absolutely. And I can definitely, we will pull out the length or when those were opened, and so that you all know the time span that it's taken that they're still open.
Super. And if it's possible to categorize them as to what kind they were, that's also helpful. But if you can't, that's fine. We're trying to be fair here in the public realm. So.
Definitely.
To the chair, also, our city attorney has resigned, so I don't know what his involvement is. And the reporting effort, I don't know if that's something that he's handling.
Right.
Maybe that the length of time is going to be expanding while we find an interim and a solution. Okay.
Great, very helpful to know. Thanks, Chelsea, for adapting the report. That'll be great for us. Anything else you wanted to bring up?
Nothing on my end. If there's any questions, I'd be happy to answer, but that is all I have to report this time around.
We appreciate it. I think we've got our questions answered. So thanks again for starting the new year off with us. And
Absolutely.
We'll see you in future.
All right. Talk to you all later. Bye-bye.
Bye. And since this is an informational item again, our action item is to receive it. I hereby say we've received it. So our next item is number 4. Receive the treasurer's investment report for the quarter ending December 31st, 2024. And we've got a staff report and the most attachments of all. So Jonathan and Carlos probably.
Have a short presentation before moving it over to Carlos and.
And I want to make sure you're not waiting for me, right?
No, Carlos.
Okay, good.
Our various accounts before presenting that off to you. So as you can see from last week to this, from last quarter to this quarter, our increased by about $20 million. And that is just largely due to operations. This does account for the $10 million that we have paid you CalPERS for the additional discretionary payment as per the council's direction. As you can see, most of the balances have remained static, with the exception of most of them just increasing due to interest earnings. So next, and at this time, the city's investments are in compliance with state law and city's investment policy, as well as California Government Code 53646, and it has sufficient funds to meet its expenditures requirements for the next 6 months. Carlos? Good. And Carlos will be going over our currently investments.
Absolutely. Good evening, everybody. I'm going to share from my screen because I realize that the version they sent out to you that's in your packet does not have the net of fee returns, and I want to make sure that you see those because I do have those, and I'm going to show them to you. I think it's important to note the backdrop that this is that we're working under right now because it's really coloring everything we do. But before I get into the economics, let's just look at the numbers and then we can talk very, very briefly about what drove things. Can you see my screen? And are you able to see the returns page that I'm showing you here?
Yeah.
Yes.
Okay,
Hey,
excellent.
Carlos, can I interrupt
Yes.
just for a second? Is it okay if we have questions while you go, or do you prefer you go through the entire flow and then we ask questions?
No, I'm happy to take questions along the way. That's not a problem at all.
Super. Thank you.
Okay, so no problem. The return for the last 12 months ended December 31st were 415. When you factor in the fee of about 7.12 or 7.2 basis points annually, you're looking at a return of 408 after the fee is paid. The benchmark was 335. You did well against the benchmark for a couple of reasons, which I'm going to get into in just a second. But I want to highlight something here that I think is really important. Had we looked at that same measure, meaning a 12-month look back, 3 months prior, meaning had we looked at that, and you did, you have it we provided to you, but had you looked at that number 3 months prior, that number would have been 738. That's how much higher it was. It still ended up being a very strong number through the end of the year, 4.15. But it's down from earlier in the year. And the reason that's just a look back 3 months prior if you looked at the 12-month number then. The reason that is because towards the end of the year, while interest rates had been falling through most of the year, interest rates popped back up. And they popped back up, I want to say starting in the month of late September through most of October, through December, even through pretty much through most of January. We're almost at the end of January, and that caused the values to fall. This is why you see, if you look at the 3-month number, you've got negative returns for the 3-month number. You earned a yield, you earned interest income, but the fair value change, the negative change in fair value as a result of those rising rates was enough to overwhelm the interest income that you earned on your portfolio. Look again, strong returns. Look at the 2-year number. That's annualized. That 438 means that you generated for an average of 4.38 per year for those last 2 calendar years, taking compounding into effect. So I'm going to roll back up and just look at the Treasury yield curve because I think that's where here we'll start with the Fed funds rate and the Treasury yield curve, and then I'll go into what we did. Yes, sir.
Carlos, that's my favorite page practically to start with, the one you just went to. And I think it's worth just spending 2 seconds on saying, well, those are very nice numbers. I mean, and Hey, by the way, I spent an extra 15 minutes looking for the net of fees. So you know exactly my first question is where are the fees in there? And I really appreciate you going to the effort of putting that in there as the adjustment. It's been one of my longtime pet peeves of not, I really want to understand net, even though of course the index is gross. I get that. So, but thank you, and a very impressive performance from my individual comment perspective.
Thank you for that. And I can't take all the credit for starting with that page. Jonathan and I always coordinate before these meetings, and he reminded me that this is important to you and to the committee. So you can also thank Jonathan for that.
Thanks, John.
Why did rates rise? So, I mean, you saw the returns. The returns were good, but they weren't as good as how we were doing earlier in the year. And even through the third quarter of the calendar year, these were all great returns, but not just the end of the year just ended up being not as good as like through third quarter. The reason for that is because the Federal Reserve, as you can see here on the right-hand side, well, they lowered interest rates. We've talked about what they do here, about how they lower that overnight lending rate between banks, and that manipulates rates. They lowered that rate in September, 50 basis points. They lowered it in November, 25 basis points, and then they lowered it again in December, another 25 basis points. But as we were progressing through the course of that quarter, it became apparent that the economy continued to show more strength than anybody anticipated. And that was primarily driven by strong employment numbers. And this is all in your packet. I won't bother you with all the details are going there. I'll let you look at it on your own. But we had strong employment numbers through those months ending the year, which led investors to believe that, yes, the Fed is lowering that Fed funds rate, but they might not be as aggressive as investors had hoped. It might not move down as fast as they thought. And as a result, investors have been backing off from the bond market and heading into the stock markets. And also, if inflation is maybe around a little longer than anticipated because there is strength in the economy, investors, especially on the longer end, those that buy the longest maturities, started demanding higher yields, meaning they paid less for it. It's an inverse relationship. Higher yields, lower values to pay for those bonds in order to be compensated for what inflation would do to their fixed payment from the future, which is to erode it. So even though rates have been coming down because of Fed activity, you still had investors think on the longer end that rates and well, inflation will be with us a little longer. This economy is stronger than expected, so they push rates higher. This is what it looked like. There's that Treasury yield curve. I'm going to zoom in on that real quickly. There's the yields for Treasuries from 3 months all the way to 30 years on 3 separate days. Here we are, December 31st. The dotted line is December 31st a year ago, December of 2023. The gray line is just 3 months ago. But I just want you to note a year ago how inverted this curve was, the front end, and short-term investments had an advantage. And the Fed did their maneuver that I just discussed, and that this came down. This impacted 2 years and in, but everything beyond that is driven by inflationary expectation. And I just finished saying that the economy is stronger than people anticipated, which might mean that elevated inflation might be with us a little longer than possible. For that reason, all these rates, you can see where they were back in a year ago, down where this dotted line is. Today, let's just look at 10 years. You don't invest in 10 years, but look at 10 years, see where they were, see where they are today. So rates are higher on the longer end. What is happening is that this inversion is finally going away. And eventually this will become steeper as the Fed lowers rates through this year. The Chandler view is we anticipate the Fed to lower rates once, perhaps 2 more times through the course of this year. We see room for that happening. How did we stay ahead of the benchmark? Well, remember that the benchmark in your case represents the amount of risk that you're taking on in this portfolio as measured by duration. You have a Treasury agency benchmark and you hold more than Treasuries and agencies. That's one of the drivers, but the main driver is the duration number. And if you remember, we had a pause for a season in this portfolio to hold off on reinvesting because there was a possibility that the city might have to take cash from here. And we've since learned from staff that no, the city will not need to take that cash. So we've been gradually building the duration to be somewhere in line with the benchmark. 3 months ago, we were at 228 years, 2.28 years. We're moving towards 248. Today, we're at 2.39. We were moving longer. It means that we were picking up those longer maturities with higher yields, and that helped the return. That was very helpful. The other piece is, as interest rates shifted higher towards the end of the year, longer investments underperformed shorter investments. And because we were a little bit, just a tiny bit shorter than the benchmark, you can see that by comparing these two numbers here that I'm going to highlight in green. Just because we were a slight little shorter, that was enough. Just look at the 3 months. It's all right there. That was enough. The benchmark went negative 76 basis points. We only went negative 49. So those are part of the reasons why. The other reason why we outperformed was because obviously, we still hold strong allocation to yield advantage securities, which continue to pay us competitive yields. Now, I'm gonna pause there. Going into the future, I would tell you should expect yields to be sticky. They'll be volatile. Yields actually came back down today, on the day, considerably. You probably heard that there was some capital markets activity related to NVIDIA. NVIDIA stock took a 17% hit on the day today, and that is the biggest one-day drop of any stock in the history of the S&P 500. And all of it was because there was news coming out of China that China may be coming out with a cheaper alternative to artificial intelligence. It's called WeSeek. That's neither here nor there. We don't know what that's going to look like, but that spooked investors in the stock markets, especially those invested in tech stocks. Those tech stocks make up approximately, when you look at the Standard & Poor's 500, they make up almost 1/3 of the index, between Apple and Meta and Alphabet, and I can't remember all the other ones, but all these tech companies make up over around 30% of the S&P 500. So as investors dropped those and sought safety, they bought treasuries, driving their prices up, which in turn pushes their yield down. So it's volatile. It's volatile. You should expect that volatility going forward. The idea here, this is a safety and liquidity portfolio. The idea is to keep it diversified on a sector standpoint, keep it diversified on an issuer standpoint, and most certainly keep it diversified on a maturity standpoint. You'll see the duration continue to get longer, even though we just, we've seen pressure higher for rates and then lower today. Eventually, if the Fed does what they're supposed to do, we still think that on the balance through the course of the year, rates will be slightly lower than they are today. And for that reason, we're going to maintain you slightly. That duration that I showed you will be moved to be slightly longer than the duration of the benchmark, but just slightly, not much. We're going to be we're going to be just conservatively longer than the benchmark. I'll stop there and take any questions that you may have.
Any members, any questions? I've got one that I'll kick off. It's sort of a merger with the staff report and the Chandler detail. We can dive. This is an accounting question. I mean, we have to cycle in and out, right? Sometimes we go theory, other times we go into the weeds in these reports. So this one's going to be an accounting kind of question on Carlos. Your page 19 in your report, you've got a really nice table on the account summary, and I don't know if you can flash that back easily.
I certainly can.
If you can, there's a number that gets picked up into the staff's treasury report, which is the cost value in that little table. There's a 170,294 number, which translates to 170.3 million. And so my accounting question, deep in the weeds, we don't need to know too much, but what's the difference between a cost value and a book value from your perspective, and why then does staff report pick one or the other? In this case, they're picking cost value. So both of you guys can help me understand that.
Absolutely. So the cost value is the amount of money that you actually paid for the securities. So if you, you know, there's a cash position, let's say that you started from, you know, from $10 million. I'm throwing out a figure. When you purchase the securities, you're paying a value for those securities. And of course, there is accrued interest that is owed to the prior owner of that security, unless you bought the security on the accrual date when it pays out its coupon, its semi-annual coupon. Somebody's owed that interest. So you have to front that accrued interest to the prior owner. But basically, the net of that, excluding that accrued interest, is your cost value. That's what you actually paid for it. Now, as you're aware, when the securities mature, they pay you back par value, which you see up here. Okay, I'm going to highlight that one in yellow. Okay, so when you purchase those securities, sometimes you're paying above par value, and sometimes you're paying below par value. And that just happens because, let's say you bought the security a year ago and you bought it at 5%, and today interest rates, let me start all over. Let's say that you have a security that was issued a year ago and it paid 5%, $1 million, 5% is $50,000. And today interest rates are up from 5% when that bond was issued up to 6%. So a new investor can buy the same bond today with a similar maturity, similar credit quality, but they get $60,000 a year. So they wouldn't want to buy your bond to only get 50,000. So if you wanted to sell your bond today, you'd have to lower the price by basically roughly $10,000 to make up for that change in interest rates. That's why when rates rise, the values fall. So you're not always buying everything at par value. You're buying it depending on what the market is doing. And so you buy something below par value or above par value. That is called a premium when you buy it below or above par value, and it's called a discount when you buy it below par value, and that's additive to your return. So what happens with that premium or discount, that amount above par value or below par value, you can either, from an accounting perspective, you can either realize it, ignore it, and realize it as a one-time loss or gain at maturity, or you can spread it out over the life of the bond as long as you hold it, as basically from your purchase date to your maturity date. And we call that you're either amortizing it or amortizing the premium or accreting the discount. So whatever amount of premium that you paid for it, you're going to ding yourself that amount, the daily equivalent from the day that you bought it to the day that it matures. So every 30 days, you're dinging yourself 30 days equivalent of that, and you're reducing your income. And if you bought it at a discount, it's the opposite. You're adding to your income that little bit every month. Well, your book value is your cost position netted for all the premiums and all the discounts that you have accreted or amortized to date. That is the difference. And if you want to get into the weeds on it, I can give a training on this. But basically, that is the difference. The cost is what you paid for it. The book value is that amount that you paid for it, but netted for whatever you've amortized of a premium or accreted of a discount to date. And that sometimes some people call that a carrying value. Now, most cities will carry their investments at either cost, at book, or at market value. Most people carry it at cost or book. Very few carry it at market value. In your ACFR, in your financial statements at year end, everybody carries it at market value, but you only do that once a year.
Right.
I hope that helps.
That's plenty of detail. That's great, Carlos. I appreciate that. That's just what I wanted. And so I think, Jonathan, you were about to explain why you guys picked cost value then as your treasurer report indicator.
So cost value is just, as Carlos said, it's what the city just did. So for us, it's easier just to record that and make sure that that's what we're reconciling at each quarter. And as Carlos did say, we at year end, as part of the ACFR, we do a mark to market.
Right. Which is even more interesting to us.
So whatever the value of those assets in the portfolio, whether it is it's valued more because you have interest or higher interest yielding assets rather than compared to the going market. So you essentially raise the value of the portfolio and you record that as interest if you want to get into the accounting side on our end. And then at the following year, we essentially reverse it. And sometimes you'll see a negative interest reversal, and that gets a little funny when we report out our quarterlies. We'll have to highlight why it's a little different because we have to reverse it out. Because again, during the year, we just we report our statements, or we adjust our statements to show the cost value.
Great,
And
thanks.
I might add one last thing really quickly. I think this is important. This return number that we show you is a total return. You can see that listed here. These are total returns. That adjustment that Jonathan just described, where that year-end adjustment, it's per GASB 31. It's you're adjusting the interest income for that change in fair value. That's why he's saying interest or negative interest. Well, these numbers right here factor those in already. That's why it's called a total return.
Right, and just to put a bow ribbon on that, that includes, I was assuming market value adjustments as well as.
Correct.
Yeah, okay, great. Okay, good. I can see all sorts of reasons you pick one or the other. It just great. So I presume it's a consistent thing. You're always using books, so you're not moving from one to the other.
We use cost during the year.
Yeah.
We don't use books.
Right.
I think from my perspective is because we're not actually making the adjustments, we're not amortizing the premiums or the discounts. It's easier for us just to report it at cost. We rely on Carlos and his team to do that amortization for us. And so that'll kind of work between, and they present those numbers.
Makes sense.
It might be also helpful to know, just to back up what Jonathan just said. Of course, as you're all aware that as your investment advisor, we don't actually touch any of this money. The money is sitting at a custodian account, a custodian bank. When the custodian reports out on these investments, they report it at cost. So it makes it very easy for the city to very quickly verify what we say they're holding versus what the bank actually says the city's holding.
Oh, yeah, that's another plus.
And that actually, that was an interesting point. Thanks for looking at that, Carlos. That was one of the AUPs that the Hunt Group wanted us to adjust. That language, it's always going to cause a difference because different firms for asset management are going to have their methodologies may be a little different, and so the market values will be different from what Chandler says versus what the custodian principal.
US Bank. Oh, principal, sorry.
Would have those rates.
Gotcha. Any other questions?
Yeah,
Sure.
I sort of had a general question, and I think you mentioned that last time that in general you invest in high quality fixed or fixed interest fixed income securities. That's
Correct.
And nothing has changed.
No, of course not. Nothing has changed in that front. You're absolutely correct. Code lays out the objectives of the city's investment portfolio. Those are mandated by the law, and they're safety, by liquidity, and then followed by return. So we have to think about safety and liquidity before we can invest in anything. And if you want, I can email you the citation of code if you wanted to look it up where it says that. But that comes from code. And then of course, if you look at the city's investment policy, the investment policy states in accordance with code, safety, liquidity, and return. In order to do that, we can only invest in those asset classes that are allowed by California government code. And those are exactly as you just described them. Very high credit quality, widely held, liquid, fixed income investments. Basically, what is that? They're bonds and fixed income instruments that are 5 years or less with a minimum credit quality of single A or higher. And code dictates maturity limits for most of them. Some of them can go to 5 years. There are some instances we can go longer, but you don't do that. That's not usually appropriate for a city. Some of them are shorter maturities. The credit quality is laid out in code. And then you also have concentration limits. You're not allowed to hold too much of one asset type in the portfolio. So it's very, very well diversified. It's exactly as you described it. It's still high credit quality, short duration, widely held, liquid, fixed income securities.
Thank you.
Great.
One last question.
Sure.
Because of what we went through last year with the uncertainties with CDTFA and so on, didn't we didn't we ask them to reduce the maturity level?
I think the duration, but I think we started to move back toward the 3-year.
Yeah.
Kind of knew it was going to happen.
And so will that change?
Yeah, we've actually saw it. Carlos, can you bring up that side where we're at from even last
Absolutely.
quarter?
Absolutely.
The duration start getting longer.
Wait a minute. Let me get the right one up there. Okay. So you should be able to see my screen.
It's 21. Yes.
Page 20. So
From 8 to 239, we're already moving back to our benchmark of 48. So we're moving in the right direction.
correct. And if I can show you the term structure, what that means is that last quarter, if you're able to see my mouse moving around, we had less investments out here on the right-hand side of this chart and more on this chart, such that they averaged this number, 2.28. This quarter, they averaged 2.39. That's what that looks like. And what you'll see is for the following quarter, less investments here and redeployed out here to basically move us back to somewhere just slightly longer than 2.48. The strategy is to maintain the investments between 1 and 5 years. The benchmark that I'm seeing here is a 1 to 5 year benchmark, which happens to have a duration of somewhere around 2.48. That 2.48 moves every month just slightly every month. So we have to rebalance all the time. And then of course that's one of the decisions that we make as your advisor, whether we want to stay neutral to that number or shorter or longer. We don't get too long and we don't get too short, because how we decide where we position that number, that out of all the decisions we make, will be the most impactful decision on risk and on return. Right now, we want to be back to strategy. It just so happened that because we were shorter and rates backed up, they came back up at the end of the year, that actually helped you. But normally it should have hindered you a little bit, but that's okay, because this was set with a long-term outlook, not just for what's happening this quarter.
It's more than a quarter, right? We changed it for about a year.
So yeah, we've been moving. So we're comparing the September 30th portfolio to the December 31st. And so it's just going to take time to adjust what our previous duration is to that.
That's correct. We make our moves incrementally. We don't ever shock this portfolio, because it's really meant for safety and liquidity. We don't want to do overnight shifts. We just don't, we dollar cost average as much as we can. So as we do this, we want to be very thoughtful about it. We don't want to do it overnight.
But we're heading in the sort of
CDTFA.
Great. So I think we got our questions answered for today, at least. Thanks, Carlos. Appreciate it. Happy New Year, and look forward to seeing you again next time. Thanks.
Likewise. Hopefully the next time we'll do it in person. I apologize I couldn't be there in person. I sit on a standing committee at Government Finance Officers Association, GFOA. And black window you see behind me is downtown Washington, D.C. at what is it now? It's almost 8 o'clock. So so I couldn't be there, but I should be there for the next.
Take care. Safe travels. All right.
Take care, you guys. Bye-bye.
Sure. Our action item on that one was again to receive it, but this one is more important than most that we receive because there's timing issues somehow. 45 days, as I recall. So, okay, item 5, receive the proposed audit committee 2025 schedule and work plan, which is now on the screen. Jonathan, you want to track us through?
So based off of changes that were discussed last at our last meeting, we ended up changing a few additional items. So seeing that today, council will have be conducting interviews for our 5th committee member, Angela Chen will no longer be with us after. Okay, so at our next meeting, we'll hopefully have that 5th person in attendance. So we decided to move the appointment of the chair and vice chair to our next regular meeting. So that everyone should be in attendance. And then we confirmed our special meeting for February, which will include today's minutes, as well as Moss Adams status report update and a Baker Tilly budget format. So we're finishing up that draft as we speak. So we'll be presenting recommendations to y'all, and you'll have an opportunity to discuss that.
And who's likely to be able to come? And we don't have 5, I guess. We've got subset.
So from my understanding, well, actually, you 3 have confirmed will be there. Hanyan has informed me that it is ski week, so he will be in Tahoe. I will be working with him to see if he would like to join remotely, but that comes with a few additional steps on his end, and then possibly that 5th member, whoever that may be.
Right, which is again, it's tough to get them in this meeting, but the sooner we can get all 5 of us together, the better. Okay, I have no other changes on this. I've seen this often enough. Anybody else have a question or a comment or? Hey, please.
With regard to the benchmarks that we were discussing earlier, was that something that's going to fit into a work plan item that's already there?
I kind of think of it as like every quarter we are tasked with looking at that OPEB and pension. So you see that up there on all the regular meetings. So I'm certainly going to raise it again, because I'm very curious what the new benchmark, or not the new benchmark, how the new presentation shows the long accepted benchmarks that we have. But yeah, great question.
But it'll be at the April meeting.
Yeah, I think when we'll that's right, 3 months from now is typical.
Some of the changes they proposed, anticipate them making those adjustments for the next report, which would be report ending October 30 or March 31st.
Yeah.
So start seeing those changes. Now, if we're planning on benchmark, typically that is done, you would see it on that October 27th. So we can start those discussions, whether we want to change the benchmark and incorporate it in the policy. Make those adjustments and have it tie up. If y'all want to meet earlier before that to make those adjustments, certainly do that and make that would fine.
So let's follow on that a little bit. I expressed my somewhat in my curmudgeonly way that I'm a little frustrated. I do hope to see some movement. I mean, I'm very open to changing the index if that's what US Bank or PFM is recommending, but they haven't really brought that up in the past. We haven't really had an appetite for that. We were kind of happy on the high level policy. But, so I'm a little disturbed that Keith doesn't seem to have a lot of background on our account. And of course, I guess our regular Dennis. But he's kind of new too, it seems.
I think Keith just stepped in. He's typically not someone that's managing our account.
Okay, so Dennis.
Dennis will be overseeing those changes and ensuring that they start, that they're incorporated in the next report.
So for example, to follow it up, if Dennis is saying, well, you should have a different index, well, then we're going to want to accelerate that kind of discussion so that we could in October have a reasonable, so I can't answer it personally in advance how we put it on our work plan, but it's sort of an if this, then that. I would hope they can come back with performance indicators because that should be something they should be doing all the time. It's not like we're asking for something that's here.
What we can probably do then, I'll have those discussions with them in the next couple weeks and see if if they would like to come back to the audit committee and make those recommendations. So if there's a change, we can either I can report out on the February 18th meeting, or if we want to come up with a better presentation, maybe at the April meeting. But want to include it maybe on the July meeting before the October to incorporate those changes into the policy.
Anyways, as we can kind of raise this, it's a great question.
I like February, but I feel like we might need a meeting between April and July to discuss it.
Well, and there's 2 points to it. I mean, if they come back and say, well, your index is wrong, therefore we can't really do anything until you tell us what the index is. Okay, so that makes us into the October discussion, which, okay, let's accelerate that would be then my answer to that is, okay, well, instantly we should change that, but I would hope they would say, well, we've been advising you on for a long time, and these indexes are pretty well established, so they should be changing their reporting. So I hope they don't come back and say, well, we can't report a modified report because your index is not right. I hope they would come back and say, well, it was a lot of work, but we're gonna come back and we're gonna show you how you're performing compared to your index. Then you know, it'd be great if you could tell us that in February, because then we'll just say, okay, great, we're not gonna do anything until October and we see it. I mean, maybe April, when you would see the March new jazz report. But if you tell us in February, well, they come back and said, well, we can't do that. You know, we have been advising you to do something incorrect for so long, now you should fix it. Well, we can't fix it because our team is, well, maybe it's a great idea for you to have that accelerated conversation and just tell us what that conversation was in February. That'd be great. Then we can give you more direction and we can deliberate more as a team here. Kind of, okay, great point, Kitty, thanks for bringing that up. Yeah, okay, so I guess we're gonna receive this too as as the chair. I mean, we should vote on those things in general, but these are, again, so we can maybe vote on the revised work plan if somebody has an appetite for that at some point. Okay, I'm gonna pause adjourn unless we have any other reports and things and staff committee reports, all these other good things. Anything? No? Okay. I declare us adjourned. Thank you. And longer.